welcome to the Quarter 3 Matthew Douglas Model Portfolio Review. Today we'll be looking at markets, the performance of the models and any fund changes that we're advising to our clients. So looking into markets, during October we saw the S&P 500 down 6.8% and the year-to-date return being up 3%. The UK top 100 companies was down 4.9% during October and year-to-date is down 3.89%. And then the MSCI Asia, excluding Japan, was down 9.9% for October, which takes its year-to-date return down 11.44%. Volatility certainly returned during October, as no doubt you'll have seen in the media. There were 10 occurrences on the S&P 500 where the daily value went up or down by more than 1% in a single day. That's 2 more times than the whole of 2017 put together. So the question is, why have we got volatility? Well, there's no clear economic reason why it's returned. Unemployment continues to fall globally. The Purchasing Managers Index remains above 50, and that's a good indicator for saying that there's global growth. And also third quarter earnings from companies have continued to beat the forecasts that we had at the beginning of the year. What's proved to give us this volatility is uncertainty, and a lot of it is down to politics. Dare I say the B word. So Brexit, soft or hard exit, we still don't know. That has meant that currencies are all over the place, and unfortunately it has pushed down on the FTSE 100. You've also had increased rhetoric from Donald Trump with his trade wars with China, and at the same time you've seen China starting to slow down. They are taking steps to try and sort of promote their economy, and we'll just have to wait and see what happens with those. Certainly being the second largest economy in the world, you wouldn't want to discount it. You've also seen the Fed in the US increase interest rates like we have seen from the Bank of England. And the funny thing with interest rate rises that we're seeing this time is that although it's something that is promoted from good economics, it's actually giving markets a bit more volatility, which doesn't seem to make sense. And then last but not least, more recently, you've had an Italian budget which has been refused by the EU, and this has raised old fears about Italy and its ability to sort of maintain its fiscal status. Our advice in terms of volatility is to stick to your long-term plan. Don't let your short-term emotions override logic. And the idea is that you don't sell out at the bottom, you come out at the top. Where possible, and it sounds brave, but invest more because you're buying more units at a cheaper price, and that will really help any following recovery. So reviewing the models for Q3, we saw in the 3 months up to the 2nd of November that the UK top 100 companies was down 5.88%, whereas our realistic portfolio was down 4.41% and the cautious portfolio was down 2.28% net of cost. We were pleased to see that in light of this increased volatility, the portfolios were able to hold up more value relative to the stock market, and this is what they're designed to do with their diversified approach. So over the year to date, the top 100 UK companies was down 4.05%. Our realistic portfolio year to date is down 0.87%, and the cautious portfolio is up 1.09%. Again, just highlighting the diversified approach, proving to hold on to more returns relative to the UK stock market. In the portfolios, the top performer has been the Legal & General UK Property Fund. This is a direct bricks and mortar commercial property fund. We don't expect to see the growth of this portfolio to be from the assets, the properties within the fund. It's more going to be generated from the rental income that it produces. The bottom performer in the portfolios has been the Merian Asia Pacific. This fund, because it's invested mainly in China, has been hit by trade wars and also the slowdown in China. The fund had an overweight position in IT and consumer discretionary stocks, and this has contributed to its underperformance. We do continue to remain confident in Richard Buxton and his team and their style-agnostic approach in being able to generate decent long-term returns from this fund and this area in the future. The fund change that we're recommending to clients is to move out of the Neptune UK Midcap Fund and to move into the Liontrust Special Situations Fund. We called an ad hoc investment committee on the 19th of September. This was pulled forward by a month because we weren't impressed by the returns we were seeing on the Neptune UK Midcap Fund. In the 3 months up to the 19th of September, we'd seen Neptune down 4.43% compared to Liontrust, which was down 0.13%. Over the 12 months to that date, Neptune was down 2.58%, whereas Liontrust was up 15.19%. And that was the type of return that we could expect from the UK equity funds that we've been holding. What we'd seen in the research was from mid-June 2018, the Neptune Fund, along with its 250 peer group, had actually detracted from the performance of the wider UK market, whereas Liontrust and other UK all-cap funds had actually been able to maintain their value. Now, Liontrust Special Situations is a $3 billion flagship fund from Liontrust, and it was launched in 2005 with Anthony Cross at the helm. He was joined in 2008 by Julian Foch, and both of the fund managers are rated Alpha on FE TrustNet. So when selecting companies to go into the fund, they're looking for those that have intangible company strengths that are hard to reproduce. These would be things like intellectual property, distribution channels, and also repeat business. Another consideration when they're looking at a company is to make sure that it has the ability to generate long-term cash flow over the long-term cost of capital in the company. A good example of this would be GlaxoSmithKline, which has consistently been able to produce cash flow returns above the cost of capital. A bad example of this would be British Airways, which has only since 2015 been able to generate cash flow above the cost. We believe that Liontrust is a good replacement for Neptune. The increased range of companies that it can invest into, be it blue chip or small cap or even mid cap companies in the UK, is well positioned to deal with whatever uncertainty we continue to get from Brexit and also global effects from Donald Trump and China. With that, we conclude the Q3 Matthew Douglas Model Portfolio Review. I look forward to speaking to you in the new year and updating you with the portfolios then.